And good evening, ladies and gentlemen. How are you guys all on this fine Monday evening? I don't know about you guys. I'm not sure where you are, scattered across the country. Some of you scattered around the world, dispersed in areas of darkness, perhaps. But here in Nashville, it is raining. It is pouring rain. It's been raining all day. It's getting cold, fall-like. And the truth of the matter is, it's probably just God crying because the Titans stink so freaking bad. I don't know. It's raining. That's the bottom line. All right, so let's discuss money management as we get into things. Here's what our class agenda is going to look like today. We're going to have our discussion on money management, basic financial planning. I've got this new mouse that if I push the wrong button, it takes my slides the wrong way. So basic money management and basic financial planning. This is our entire discussion for the evening, and hopefully it is a valuable discussion for you as we move forward. So let's discuss it, money management. Now, money management is quite possibly, I don't know if it's the most important issue of learning to trade, but it's one of those things that it's going to be the difference in whether you actually make a profit or not. Let's just put it that way. There are lots and lots of people that trade the market. It's no secret. There are hundreds of thousands, millions of people around the country, across the country, around the world that trade the markets, and the statistics are not in their favor. Interestingly enough, the statistics for the general public trading the market have never been in their favor. I was just recently reading some old literature from like the 1930s, 20s, 30s, late 20s, early 30s. And the same problems that you see in the headlines today, the same statistics of the market, the public participants in the market losing money, they were true 80 years ago. It's crazy. Nothing has changed, and it's always been the issue. And what do they blame back then? Oh, they were blaming bad economies. They were blaming brokers that screwed you over. All sorts of stuff. And yet the traders who made a good profit 80 years ago are using the same statistical and same types of technical trading tools that we're using today. Now, some people would argue with me, and they would say, well, technical trading really isn't the best way. You have to use fundamentals, blah, blah, blah. And then they always cite people like Warren Buffett, for example, and they cite Benjamin Graham, the father of value vesting. And, I certainly respect those individuals. There's obviously nothing wrong with those individuals in any way, shape, or form. They're amazing human beings. But here's the challenge. Those strategies, the strategies of buying stock and trading it and holding it for a long time and letting it go up, that strategy only works in a bull market. The traders that can make money in any market have to be more flexible. They buy and short. And the reality is fundamentals alone cannot reflect the immediate turns of trader sentiment. And so you've got to learn to be a technical trader. You go back in time, you look at traders, for example, like Jesse Livermore from the Great Depression, made a couple big fortunes. I'd have to go back and research it, but he made one big fortune right in the Great Depression, like getting into it right around 1929, 1930. Made another one during a previous crash. But anyway, bottom line, he's worth $150 million in the middle of the Great Depression. When everybody else was going broke, he's making a fortune. Traders like that, they have consistently, over the years, for the last 100+ years, used technical tools, the same stuff that I'm teaching you guys. A lot of the tools that I've taught you over the last several weeks together, couple of months together, a lot of these tools have been well-defined since the time of Charles Dow and moving forward. We've talked a good bit about Dow theory being codified around the time of the Great Depression. And one of the famous books is a book by Edwards and McGee. It's kind of the traditional classic Bible, if you will, of technical analysis. It's called the name is slipping me. Technical Analysis of Stock Trends, I believe it is. It's been through a bajillion revisions, and there's a guy in California that keeps updating it, and I think it's in its 8th or 9th printing now, but or revision, I should say. Anyway, classic book. And the basic patterns that Edwards and McGee were teaching in the 1930s and 1940s, same stuff that we look at today. It's fascinating to me. I can pull up literature from 5 years ago, literature from 55 years ago, and it's saying the exact same stuff in terms of the basics of technical analysis. Now, here's the difference, though. What's the difference in those who make a profit and those who don't always comes down to how they implement their strategies, and then ultimately it tends to be the people who survive the market are the traders who have good money management. That's really where I was going. In the process of my discussion that I was just making with you guys, I realized that I had the wrong slideshow open. So if you don't mind, I'm going to stop sharing this with you. And I'm going to try to pull up the right slideshow. This was an earlier revision, and I'm realizing it because the graphics are wrong. So let me see if I can find the correct one, which seems to be missing from my folder at this moment. I got to find it here because what happened is my buddy Shane, who helps me do images, he saved a new one and I can't find it. So hold on just a second here because I clearly drug this class to the wrong spot. In fact, let me just mute myself for a moment. Talk amongst yourselves and please forgive me. I got to find the right one because I'm going to have the wrong slideshow all night. It's going to drive me nuts. Hold on one second. Okay, now I got the right slideshow. I knew it was the wrong slideshow because my piggy bank was missing. All right, so lots of people trade the market. Here's the interesting thing about lots of people trading the market. Lots of people make a lot of money trading the market. However, the sad part is statistically speaking, at some point in their life, most people are going to blow out their account. Statistically speaking, they're going to blow it out more than once. I got some really disturbing insider information that I'm going to share with you guys about brokers. And I learned this from a industry insider. And here's the news that we get from brokers, or the not the news, but the statistic. The statistic that brokers give is however much amount of money, whatever amount of money you deposit into your brokerage account over the life of your account before you quote unquote blow it out, in other words, take it down to zero, the average trader will spend that amount of money in commissions. Now, that's interesting information to know. So your brokers who say, hey, come fund an account with us, give us your $500 or your $1,500, whatever their minimum funding requirements are, and don't worry about learning to trade, don't worry about practicing, just come spend your money paying commissions and start trading and see what happens. They have worked it out, and they've averaged it out, and they figure out that the average trader over the life of that account will give them approximately the value of that account in commissions. Now that's interesting because what the brokers are expecting is that you will go broke. Now this is sad. And I learned this from actually a great discussion I had with Glenn Larson. Oh, I shouldn't have revealed the name. Sorry. Anyway, we were talking about why it is that the brokers don't care about your trading education. And I just can't figure this out. I'm like, why is it that brokers don't seem to want to get on board with training their account funders? And Glenn's insight from his years being in the industry said, hey, here's what the statistic is. He knows it because he's worked with many, many brokers on the inside. And he said, basically, they don't care whether a trader is successful or not. All they care about is receiving the commission. Well, of course, that's the exact opposite of what I care about. I want you to be successful. I've been on the other side of it. I've blown the accounts out. I've given away all those commissions before. And, for me personally, I have the different passion of it. I say, hey, I'd rather not see you trading real money. I'd rather see you trading fake money until you really know what you're doing, until you've really got a good system that you can rely on. So, here's just some interesting facts. There's a lot of people trading the market. A lot of people make a lot of money. Statistically, though, they're going to blow it out. Here's the secret to trading success. The secret to success is in both risk management and money management, and that's the nature of what we're going to be talking about here tonight. Okay, so let's talk about a path to destruction. Brilliant traders, that would be people like you. Brilliant traders can and do go broke. You've got to know this, guys. If you're trading the market, you must know that going broke is a very real possibility. In fact, it's a statistical probability. Let's just be honest about it. Now, interesting thing about this, another trainer, Courtney Smith. Some of you guys know Courtney Smith, but he has an interesting insight on this, talking about why traders trade the market. And, as we were talking about psychology, I thought this was really quite interesting, his insight on it. For some people, whenever they come to the market, They're motivating factors because they want to be something. For example, they say, hey, if I could just trade the market, I can make a lot of money, and then I will be something. My mom will be proud. My dad will be proud of me. I'll actually have something of substance for my life. Other people, whenever they trade the market, they say, I'm looking for financial security. That may be their motivating factor. For other people, it actually has nothing to do with financial security or status symbol or anything else. It simply has to do for the thrill. I thought, wow, what an interesting insight. It's true. I've got students in here. I'm not sure if I have them in this class. Most of them don't survive this long. But I do have students that come through, and they may have lost $100,000 or more trading the market, and they think, oh, I'm going to take a couple classes and learn to trade better. But they refuse to trade fake money. They refuse to do the trader conditioning system. They refuse all these basic ideas that I try to lay out to give you guys some structure. And I can't ever figure out why. Well, I think Courtney had the insight. They're not in it for making money. They're not in it for the status symbol. They're in it for the thrill. And his insight was quite fascinating, because if you talk to a group of people and you say to this group of people, hey, how many of you go to Vegas and you walk into the casino and you have the idea that you're going to walk out with more money than you walked in? Very few people would say they have that expectation. And yet, millions of people every year go to Vegas, and some of those millions of people actually take millions of dollars into the casino with zero expectation of walking out with a multiple of that million. Now, isn't that interesting? So the question then comes down to, why in the world are these people trading the market? Why are these people going into a casino? If you go into a casino expecting that you're going to get rich, then the odds are heavily against you. If you go into the market expecting to get rich, then the odds are also heavily against you. How does somebody go into a casino and actually beat the house? Well, statistically speaking, you can't beat the house, and yet there are people who have figured out how to beat the house, but they've got to have the right strategy, they got to have the right system, and there's certain games you can't beat, and there's certain games that you can beat, right? Well, trading is similar. There's a lot of brilliant traders that make a lot of money trading the market. And a lot of those traders still go broke. One of the most famous traders in history to do this, Richard Dennis. I'm not sure if any of you guys know this guy, but Richard Dennis had a famous group of traders in the 1980s. He called his turtle traders. You can still find quite a bit of information about Richard Dennis and the turtle traders. Just Google Richard Dennis, turtle traders. You'll find plenty of information. Curtis Faith is probably the most outspoken turtle, but there's a few of them out there floating around that still talk about it. Richard Dennis was worth several $million, and when I say several million, well over $100 million. Great commodities trader in the 1980s. And Richard Dennis had a philosophy, much like my own, that anybody could learn to trade the market. They just needed to have a simple system, follow the rules, and not break the rules. And if you follow the rules, the statistics would eventually work out and you would make a profit. Well, Richard Dennis proved his theory. His turtle traders became one of the most famous groups of trading pupils in history, and one of the most profitable groups in history. But Richard Dennis himself went broke. Now, why did Richard Dennis himself go broke? He didn't follow his own rules. Isn't that interesting? So you can know everything. You can actually be a brilliant trader and still go broke. And how do you do it? You start to bend the rules. You start to lack discipline. You start to lack money management. One of the biggest things that Richard Dennis did is he lacked good money management skills. He would start to place bigger positions on his losing trades and try to average down or try to double up. So whenever he started to have a losing trade, he'd double up trying to counteract it. And this simply becomes gambling. And here's the reality. We're just talking about facts here. I'm not telling you exactly what you need to do at this point. I'm just talking about the realities of the market. The realities of the market is you can know everything. You can have all the technical information. You can have all of the breakouts. You can have all the entries. You can have all the protections in place. But if you don't follow the rules, or if you let your emotions take over and you don't actually adhere to your system, it's all useless. It's all useless completely. Another very, very famous trader, Jesse Livermore, I already mentioned him tonight, ended up killing himself. At one point in his life, he was worth well over $100 million. And this was in the Great Depression. By the time he killed himself, he only had a value of $5 million. He actually, if I recall, he was in bankruptcy at the time of his suicide, but he he had actually stored some money away in trusts for his kids and for his family, and it was only worth about $5 million. So you say, well, hey, I'd still be happy with $5 million. Well, a $95 million loss for some people is enough to make you want to kill yourself. For other people, a $95 million loss is just a fact of the game. And this is really where the psychology of being a trader comes into play. What is the value of money to you? Is money a tool that you use to trade? You use it to either trade for more commodities, you use it to trade for, and when I talk about commodities, I'm talking about things. I'm not specifically talking about the commodities market, although you could do that. But what is the tool of money? Is it a tool that you can use to buy more time from people so that you can leverage your business? How do you see money? For some people, they see money as an identity. And if you don't have the money, if the money comes to you and then it disappears, they don't know how to move forward. I would say Jesse Livermore was one of those people. Came out of poverty, learned how to make a lot of money trading the stock market, and what ended up happening? Well, he made a lot of money a couple times, went broke, bankrupt several times, and in the end, couldn't handle it, ended up killing himself. All right. Interesting story, interesting study. Now, people have heard me say often, nobody ever died trading the stock market. And that's true. Nobody has ever died trading the stock market. However, when you get your values out of line, when you place too much of an emphasis on the value of money, and then you lose that, then it can drive you to do crazy things like Jesse Livermore, where you end up killing yourself because you don't actually have the core value. Then my last two examples, me and you. Guys, we're no different. You know, if we don't keep a good structure around ourselves and we don't do the things that we talk about doing, what's going to happen? We go broke. It's just the nature of the market. And so you can play with the market all you want. You can beat the market all you want. I mean, I'm telling you, I've made tens of thousands of dollars in the market. I've given back tens of thousands of dollars. I've made more tens. I've blown out accounts. I've blown up accounts. It's incredible what you can do in the market. The market's fantastic. And yet every time I look at the market and I think, oh my gosh, look at the amazing amount of money I just made. And then if I get too arrogant about it, just like everybody else, what happens? You start to have one loss after another, they start to pile up, and then if you're not careful, if you don't put strict rules around yourself, it will take you down. And so tonight's class is a very interesting class, very important class, because hopefully from a money management standpoint, I can give you some tips and some tricks that will help keep your emotions in check and give you a trading plan that at least you're not going to blow yourself out, certainly not immediately, and hopefully you can live to trade another day. Now, overarching everything here, there's an important rule, and I should have put this on a slide. I didn't, but here's the very, very important rule. When you start to take on several losses in a row, if you take on 1 or 2 losses, it's not a big deal. 3 or 4 losses, you're starting to have a problem. 5 or 6 losses in a row, you better stop trading. Just stop. Do not keep trading. Do not keep doubling down, trying to get back to even. Don't do it. You're going to absolutely blow out your account. And that's just the reality. It's what the statistics say. It's what experience says. It's just the reality. If you start to overtrade, trying to compensate for whatever incompetency you had at that moment, you will make a mistake, and it's not going to be fun. So what do you do when you start to lose money? My strategy, Josh's strategy, what we have learned is if we get into a sequence of bad trades, we back out, we stop trading, and we go back and we start looking at what we're doing. Sometimes it's just as simple as stepping away from the market for a week or two. And sometimes it's as more complicated as going back to virtual trading, saying, okay, let me get my balance here. What's going on? And this is just the nature of the market. That's called self-discipline. You've got to have self-discipline. If you don't have it, guess what? I can teach you until I'm blue in the face. You can be the best technical analyst on the planet, and you will still end up screwing up. Some of the most brilliant traders in history have done it. You are no exception. Now, here's the caveat there. There's a lot of money to be made in the market. And so it's worth it. In my opinion, it's worth learning to trade the market, worth using it as a cash generation tool, and worth becoming really good at it. Because in the end, it's rewarding. It can be financially rewarding. It's emotionally rewarding. There's all sorts of rewards sitting here in the market. I love the market. I think it's an amazing place. I think it's the best symbol of capitalism in the world. I just love the stock market. So, I mean, you guys obviously know that. But I'm also very, very cautious and very, very much respect the dangers of the market, as should each of you. So let me give you some secrets as we move forward tonight. Biggest secret. Biggest secret in trading, the secret to money management is to never play with your entire account, ever. These are brilliant words spoken by a brilliant market technician named Jeremy Whaley. Brilliant, brilliant. The secret to money management, never play with your entire account, ever. How do you think I would ever, in my wildest dreams, come up with such a crazy rule? I have done it. I have put everything on a trade and lost it. I tell you what, guys, I've learned most of my lessons the hardest way possible. And most of the times, whenever you learn a lesson and you spend real money on it, here's what happens. You come back and you analyze it later and you say, why did I do that? And you realize, oh, yes, I knew better. And I did it anyway. So the biggest, most important lesson in money management is to never play with your entire account. I think of a student who will go nameless. Her name, she was a she. We will call her, Margaret. That has nothing to do with her name. We'll call her Margaret, though, just so I have a name to give her. She was a Canadian student, came to us several years ago. And at the time that she came to us, she was a nurse working in a hospital in Canada. And she had taken out a personal loan, not from a bank, but from family members, in the amount of approximately $250,000. On her first trade, she made over $80,000. So she had about $330,000 in her account. Then she proceeded to lose all of that money. And she lost her account down to about $120,000 when she found TradeSmart. When she found TradeSmart, she went through our classes and she learned a strategy called a straddle strategy. She placed one straddle trade and made $45,000 on one trade. And I mean, we were just really proud of her at first, but the problem was then she continued to keep doing straddles and she couldn't figure out why she was losing money. And she continued to lose money, and she continued to lose money. Before she knew it, her account was down to $80,000, $75,000, $60,000, $50,000, $40,000, $30,000. She finally gave in and called and asked for personal one-on-one counseling when she had her account down to $15,000. Wow. Now that's serious drawdown on your account. Okay. As I started working with this student, I started looking at her trades, and the first problem I found was every one of her trades was her entire account. She did not save a percentage of her account to live to trade another day. The reason she was able to make $45,000 is because she had so many freaking contracts. The reason she made $80,000 is because she had this huge trade. She had $250,000 of capital on the trade. Her first problem was that she put 100% of her account on every trade. Now, you can see that was a painful lesson for this young student. The next problem that she had, realizing that if you lose 50% of your account, it takes a 100% profit to get you back to zero. Every trade, she would start doubling up and placing more and getting more and more risky, hoping for the big one to hit. Well, whenever you take higher risk, what's the problem when it doesn't work out? The problem is you have twice the hit. And she was just breaking every rule of money management, including the final, most important one. I realized that obviously she was trading real money. I knew she was trading real money, but she never did any of the trader conditioning process, and she never did virtual trading. And her simple excuse was, it's not any fun. And now poor Margaret, that's not her name, but poor Margaret, is sitting on a personal debt to friends and family. Not even a bank. She can't even file bankruptcy and get government protection for $250,000. And she's got $15,000 left to work with. And by this point, we not only had a trading problem, we had a psychology problem. And I'm going to be honest with you, I never could break it. I worked with her for 12 weeks. She was a great trader in terms of she had the technical analysis. I got her down to where she would manage her account and she would only place a few few trades per her account. She would diversify over several trades. Rather than doing just one big trade, but I never could crack her psychology. Now, granted, I'm not a psychologist, so, maybe that's what I ended up doing with her. I said, you got to get some help on this, because she got to the point where she was so freaked out about getting back the money that she could not think emotionally balanced about the trading. Okay, now I tell you this is a very sad story. I tell you this because if you will put some rules in place, you'll never end up like this poor student. Biggest rule, you should never start off with a $250,000 account. If you have no idea how to trade, you are literally a fool for starting off with $250,000. Now, I'm not going to sit here and say you shouldn't trade $250,000. If you feel comfortable managing that much, you're more than welcome to manage it. But if you're a green trader and you've never traded before, you don't need to start off with that kind of money. The smaller your account, the more important risk management. Consequently, the smaller your account, the more disciplined you're going to be simply by nature. Okay, so those are very, very important, tough lessons. Hopefully, each of you will take that lesson and say, "Not I will never do that." All right, so secret of money management: never play with your entire account ever. Some corollaries: do not risk everything on one trade. That is foolishness. Do not play with money you cannot afford to lose. Poor Margaret could not afford to lose her personal loans, and yet she was playing in this marketplace with money she couldn't afford to lose. My first experience with this came whenever I took a $1,500 mortgage/rent payment that I needed to pay a living expense with, and I said to my wife, this is a long time ago, I said to her, "Hey, I got a great idea. Let's just take this money and let's go trade it real fast and I'll make a bunch of money." And of course, I lost it. Now I couldn't pay my mortgage with it. That was a problem. That spiraled into further problems. And my biggest lessons, my biggest, most painful lesson it ended up being about a $24,000 lesson at the end of the day. I actually went on to make and lose much more money than that. But the $24,000 lesson was the one that was the most painful, because it was money I could not afford to lose. And when you trade with money you can't afford to lose, that just screws you up. And once you're screwed up emotionally, it's really, really hard to get balance. And that's probably some of the best advice I can give you is if you're in a desperate place emotionally, you probably are not in a mental capacity where you can trade that day. You've got to get to a place balanced emotionally where you know what you're getting into is something that if you take a hit, it's not going to sink the ship. If you take a hit, you can recover from it. You've got to have balance. If you don't have balance, you're going to get screwed up. It's just that simple. Okay? Do not ever take for granted the speed with which all of your fortunes can turn against you. One of my favorite painful lessons that I got to learn was the first time that I learned about a particular type of a trade, actually the same one that my example Margaret did, straddle trade. One of my first big option trades, actually, I got into this trade for about a $1,500 trade, or for $1,500 capital investment, and overnight, in less than 24 hours, I had a $4,500 profit on this earnings trade on a company called PetSmart. You guys probably know PetSmart. Anyway, so I had about a $4,500 profit. I was so excited about it. I called Josh, who at that time in life was not even trading. I just like, "Oh, dude, I just made $4,500. He's like, "Great. Did you sell it?" I was like, "No, man, I think it might go further." He's like, "Sell it, man. Take the profit." I was like, "No, let's see what happens." And I proceeded to watch this trade over the next hour and a half of trading. I proceeded to watch this gap fill as it went all the way back down, all the way to my break-even point, and then some. And before I knew it, I closed the trade for a $200 loss. Ouch. Now, that was a painful experience, an experience that I have never relived to that extent. You get into a trade, you have that kind of profit, you learn before you get into a trade where you get out with certain strategies, because there is no telling how fast you can lose your profits, okay? I'm telling you what, I have watched profits come and go very, very quickly. I think at times I have become numb to profits coming and going, but obviously it has served for the better good because it's given us all great rules which we can abide by. So never take for granted how fast your profits can erode. Now let's talk about human nature just a little bit here. Human nature naturally wants to outperform its own rules. Why? I don't know. It's called human nature. We want to be better than what we are. And we like to say, hey, I set myself some rules. I followed them. I made a lot of money. Let's see if I can make it better. But rather than practicing it in a virtual account and seeing if we can better our rules, what do? We go into real money and we say, well, this time I'm going to break my rule. I think this time it's really going to work. And 10 times out of 10, that's the one where you get burned. I'm telling you what, guys, I have made a lot of money trading the stock market. And every time, whenever I screw up, I start breaking my own rules. It's just that simple. It's like clockwork. I don't even have to predict it anymore. I can just tell you, or I should say I don't have to study anymore. I can predict it. I can just tell you exactly what I'm going to do. If I break my rules, I'm going to lose money. It's just that simple. So why? I don't know. It's just human nature. We want to better our own rules, and yet that's the worst thing you can do. Okay? Success breeds disregard for structures that helped you get to where you are. Why? I do not know. It just happens. So beware of it. Going into this battle, if you will, following the metaphor, going into the battle, be prepared for the enemies that are sitting right around the corner. And once you find success, immediately, one of the first things you're going to do is find a certain amount of arrogance and a certain amount of pride. I don't believe that arrogance and pride in your success immediately leads to, a worse state that we would refer to as greed, but it does lead to self-destruction. And, maybe this is just a divine way of keeping us humble. Maybe that's the nature of it here. Rather than allowing us to get too greedy, what happens is arrogance and pride just immediately leads to self-destruction, which prevents all greed from kicking in, right? I don't know. All I know is this is a rule that I have found. Once you start to see a series of success, be careful. Arrogance and pride is sitting right around the corner, and the only way to overcome that is extreme discipline. Extreme discipline. This is your key. In fact, a great book that what is the guy's name? Mark Douglas. You guys should all read this book. Mark Douglas. It's called Trading in the Zone. He's got another book that was the precursor to it called The Disciplined Investor. And he hit the nail on the head. I mean, Mark Douglas, what was so great about his book is he was able to say in a book what everybody knew, but nobody would say. And it's just this simple. When you have a set of rules and you don't follow them, you're destined to destruction. It's just that simple. The book, both of those books, Disciplined Trader and Trading in the Zone, are both great books on trading psychology. He's one of the few people that's done a lot of research on trading psychology. And discipline is the key. It's just that simple. Chet Holmes said it this way: the successful person realizes success is only a handful of actions which must be repeated thousands of times with pig-headed discipline. You go find success, don't change it. Why did Henry Ford find success in manufacturing automobiles? Because he said, look, I found something that works. I don't need to keep changing it. Why did Ray Kroc find success at McDonald's? People were buying these nasty hamburgers. Let's just keep cranking them out. We don't have to keep reinventing the hamburger. In fact, it's not even a good burger, but people like it. Why? I don't know. It's predictable. And what do? You keep repeating it. When you find something that works, just keep repeating it. Don't keep trying to tweak it and outperform it and make it better because you think you're brilliant. It's just not that simple. Now, Scott has written in here, Sam Snead, the famous golfer, used to tell him, by the way, Scott Anderson is a professional golfer to some extent. He used to be professional. I don't think he's pro anymore. But anyway, Scott Anderson, the brilliant golfer student in our class here, has said, Sam Snead, the famous golfer, used to tell me, when you think you've got it, you've had it. Great advice from the old Scott Anderson. Thank you, Scott. Anyway, Chet Holmes, pig-headed discipline. King Solomon, fools despise wisdom and discipline. Now, that's coming from the man who, in estimates, has had the greatest net worth of anybody in world history. Only a fool despises wisdom and discipline. So what does this say to you? And what does this say to me? We need to fall in love with discipline. And I'm the first to confess this. As a musician, musicians, people always say, well, musicians are very disciplined. You get good at your instrument by being disciplined, but musicians inherently are the least disciplined human beings on the planet. We're just a bunch of slobs. Okay? Why? I don't know. But as a musician, this has been the hardest personal character trait for me to change. And, I'm a heck of a lot better today than I used to be, but sometimes you just get into a funk and you don't have good personal discipline. Self-discipline is your key to success. You've got to learn self-discipline. A lot of times people, I reframed it this way. People say, oh, I'm not self-disciplined. I used to say that. I used to say, oh, I don't have very good discipline. Then I realized that discipline is nothing more than good habits. That's it. Discipline is nothing more than good habits. So learn good habits. And whenever you can look at yourself and say, I have a bad habit. For example, if you have a bad habit of, pick something. You have a bad habit of picking your nose in public. It's a bad habit. Does that mean that you can't have good habits? No, it just means you learn to stop picking your nose in public, right? Probably a bad example. That becomes a discipline. A discipline is anything that you consistently do over and over and over. It's just a discipline. That's it. So you learn to have good habits. You learn to set up good habits. And in your trading, you must have good habits. It's just that simple. You've got to fall in love with having good habits. So let's establish some good places in terms of money management where we want to have some habits, okay? And here's my 5 steps or 5 areas. Is this the end of the road? It's probably not. The truth of the matter, teaching money management, there's no science to this. I'm giving you guys some good ideas, but you guys are going to have to really just keep working it. I think every trader is on a lifelong journey to discovering the right answers. Technical analysis, there's almost a science to it. There's a lot of art to it. But it's very textbook. I can teach you technical analysis all day long. How to place a trade, I can teach that to you. How to pull it together into an analysis system, I can teach that to you. Money management, there's so much emotion involved in money management. It's really hard. At least that's what I personally find. And the people that I've talked to about it, other educators, other trainers, other authors and stuff that I have interacted with it all, we all come to the same conclusion. There's some basic principles, but it really comes down to the individual's personal habits, personal discipline, and personal emotional makeup. So let me give you guys some structure here, okay? Scott Anderson, by the way, has written in another great comment here. Jim Rohn used to teach us how to learn to love discipline. When you learn to do that, self-discipline becomes a joy. What an awesome, awesome statement. Absolutely. Brian Tracy has a great program. What is it called? I forget the name of it. I will think of it. But some of you guys feel free to go to Nightingale Conant and just look up Brian Tracy programs. And he's got a great program on self-discipline. And it's just self-discipline is the key. It's one of the biggest keys. All right. A couple places where we start. Risk reward, risk per trade, stops, capital extraction, and avoid no mistakes. Let's break these down, see if we can't get some better money management ideas under our belt. Risk reward, the number one risk management technique of every great trader. How many of you guys know who Paul Tudor Jones is? You guys familiar with this man? Paul Tudor Jones is one of the most successful hedge fund traders and managers in history. Depending on who you talk to, he's one of the top 15, 20 traders in the world. He made, I forget the exact amount, but I think it was around $500 million in one day during the great crash of 1987. And when other people are freaking out, what's Paul Tudor Jones doing? He's making a bunch of money. Now, here's the interesting thing. Paul Tudor Jones has made it very clear. He loses more trades than he wins. But because he keeps his losses to a minimum and he's able to maximize his winners, he's able to be one of the greatest traders in the world. Very, very, very important principle. By the way, Anna has just fired in here a quick statistic, says that Paul Tudor Jones is worth $10 billion. I did not have his net worth on the top of my mind, but that does not surprise me. I did know that he was on the billionaires list, so that's good enough. There's only about 1,300 billionaires in the world. So when you talk about a billion, it's a lot of dollars. If you can get there, you've done something right. Paul Tudor Jones loses way more trades than he wins, but he keeps his losses to a minimum, maximizes the rewards of his winners. Now, every great trader knows this. In fact, I'm going to tell you guys, I don't often tell you other books and stuff that you need to read, but I've really come full circle on a couple of them. Most of the time, I don't tell you books because they tell you a bunch of stuff you don't need to know, and the good stuff, you don't know how to harvest it. And so that's why I don't usually tell you guys names of books, but I really think everybody should read the Stock Market Wizards series. And I have mentioned this a couple times. Stock Market Wizards, there's several books in the series now. Paul Tudor Jones was featured. I can't remember which one. You guys can just look them up on Amazon. Paul Tudor Jones was featured in one of them. There's a more recent one that's put out, Stock Market Wizards, Hedge Fund Wizards, I think it is. Jack Schwager is the author. And what's fascinating, as you look through these great traders, they all have one common characteristic. And, this is a characteristic that you only learn with success and failure. And that's just the nature of it. That characteristic is risk management. Pretty much every one of the stories goes the same way, it seems like, whenever you read them. I learned to trade. I made a lot of money. I went broke. I made a lot of money. I went broke. I made a lot of money. I learned that I can't risk as much money as I used to risk if I want to stay not broke. And so every one of these traders has scaled back their expectations on their overall account, even though they still use the option strategies and the stuff that I teach you guys to use. And you may make 50 or 80 or 100 or 200 or 300% profit on one trade. It doesn't mean you're making 200 or 300% profit on your overall account. Your overall account, depending on how big your account is, you may only make 5 or 10% a year, especially when you get into managing billions of dollars like a lot of these hedge funds are. A hedge fund manager, until I really started studying their money management principles, I never could figure out why hedge funds only were making, 30 or 40% a year, and some of those were going broke, and the ones that were really sustaining were only making 15, 20%. I couldn't figure it out. Then I realized it's all a matter of risk management. You can't risk that much money and keep it. And so you go out and you put your money into a highly leveraged option trade where maybe you're going to make 300%, but if you lose it, you lose all of it. Well, you're really screwed up. And so money management, risk reward is very, very important. All right. Number one risk management technique of every trader is your risk reward. Here's how we figure it out. Do not settle for less than 2-to-1 reward for every dollar that you risk. But you really need to be looking for a 5-to-1 risk reward. Now, how do we really factor risk reward? This is something that I talk about, and it's kind of scattered throughout, but I want to really lay a better foundation for you. Risk reward is very much misunderstood. So let me show you how it works. Risk reward does not mean risk is equal to capital. That's not what risk reward is. Risk is equal to where your stop loss is, or your risk, where you're willing to say this trade has gone against me, okay? So let's say that your entry price, what does every key trading plan need to have? Every key trading plan needs to have an entry, a target, and a stop. Okay, so let's say your entry is $100 and your target is $120. What is your potential reward? Your potential reward is the difference here, or $20. Okay, now what if your stop, the place that the stock will tell you that the trade's gone against you, what if your stop needs to be set at $95? What is your potential risk? Well, it's $100 minus $95, or $5 per share. What's the ratio? 20-to-5 is equal to a 4-to-1 ratio. You're willing to risk $1 for every $4 in profit. Does this make sense? Entry, exit, and stop. You've got to have these pieces of information in front of you. Now, here's the interesting information. If you risk less than this, eventually you will go broke. Take a look at my little chart here. Let's assume, and everybody's going to end up differently. In a perfect world, you would have a better than 50% of the time where you're making a profit and less than 50% of the time where you're losing money. Statistically speaking, 1 out of 3 trades is going to be a winner and 2 out of 3 trades is going to be a loser, because statistically speaking, you've only got a 33% chance of making a profit. Okay, that's the statistics talking. Now, hopefully, by the time you've gotten through all of the education I've given you, you've learned to read the market, you've done the trader conditioning, you've learned some really good discipline. Hopefully, you can get yourself to a point where 5 out of every 10 trades is a winner. Okay, now let's just assume that your risk reward is 50 cents to $1. If you win 5 out of 10 trades and you make 50 cents, you're only making $2.50 profit on those 5 out of 10 trades. Okay, now on 5 of those trades, you're going to lose $1 because you're risking $1 to make 50 cents. Where does that leave you? That's a $5 loss. Oh no, your overall account over those 10 trades is in the negative $2.50 per share. Just recognizing the risk reward alone can turn many, many people into a winning trader. How many of you, whenever you get into a trade, you actually consider this? Am I risking more than I can afford to risk? Okay, now what happens if you increase that to dollar for dollar? Well, dollar for dollar is break even. If you make 5 winning trades and you make $1, you got $5 profit. If you have 5 winning trades and you lose $1, you've got a $5 negative. That means you're breaking even over 10 trades. Too much work, too much stress. You're losing money on commissions. It's not a winning deal. You've got to have at least 2 to 1, and you've got to be making at least 50% of your trades for a profit. If you make 5 trades for a profit and you make $2 on each trade, you made a $10 per share profit. You make 5 shares for a profit, make 5 trades for a profit, make $1 per share, you're losing $5 per share. $5 over 5 trades. That leaves you with a $5 per share profit, and at least you're in the black. 2 to 1 risk reward minimum. Minimum. If you accept less than 2 to 1 and you're risking too much overall, you are going to be screwed eventually. You'll go the ways of Richard Dennis. You'll go the ways of Jesse Livermore, except for hopefully you're emotionally more stable and you won't shoot yourself. And if you're not careful, you'll get yourself in a situation where you become a broker's statistic. And they make all their money on your commissions and you never make any money. Okay? Now, what happens if we increase this? 3 to 1, 5 of your trades, you make $3 per share. You just made do your math, Jeremy. You just made $15 per share. On 5 of your trades, you lost $1. You just lost $5. You made $10 overall. Interesting. Now, if you can increase your risk reward to 4 to 1 or 5 to 1, look what happens. Your gains are going up exponentially. Now, John has written in, he says, 5 to 1 is very hard to find. You're right. And that tells you something. You might be over trading. Great traders learn to lay in wait. Jesse Livermore in his book, whatever the name of his book was, made the statement towards the end of his life, before he killed himself, he made a statement that he had learned to wait for the trade setups much better than he had done earlier in his life, where he made a lot more money when you didn't wait on the trade setups, but you lose the money because you're not waiting on them. You're over trading. Stable traders, and you have to decide who you want to be. You want to be a gambler, you can overtrade. You're just going to make a lot and lose a lot. But you want to be more consistent over time, be able to take some profits out. Learn to lie in wait, waiting for the best trades to show up. Courtney Smith says he prefers a 10 to 1 risk reward ratio. I need to go research this. I believe Paul Tudor Jones, I believe that he's a 10 to 1. A lot of hedge fund managers are somewhere between 5 and 10 to 1 risk reward, and that's all they will take. Now that's interesting. That's very interesting. Now, what if you can better yourself? See, I personally believe everybody can better themselves. What if you can better yourself and make better than 5 out of 10 trades? What if you can make 7 out of 10 trades for a profit? And what if you can stick to this risk-reward ratio of at least 2 to 1? Well, now you're getting exponential returns. If you just can better your winning percentage from 5 to 7, 2 more trades out of your 10 trades, just 2 more trades becoming winners. Look at this. Even with a 50 cent to dollar ratio, which is a stinky ratio that you should never settle for, even with that, you get into a scenario where you're at least making a profit, but you got to win a lot more. It's a lot of work for 50 cents. But look, as you get into the 2 to 1 category, you're making $11 instead of $5. Look, as you get into 3, 4, and 5 to 1, $32 for a $3 worth of loss overall. That's incredible. And then you can afford, when you do get into a negative cycle, and maybe you do lose 5 or 6 or 7 trades in a row, you're not going broke, because you've learned to limit your risks and you're making a lot more consistently over time. Now, is 70% of your trading profitably, is that realistic? Well, I don't know. I have hit this many, many times. I have consistently over time had winning trades out of 10 trades, and had 7 or 8 out of my 10 trades that are winning trades, especially if I do credit spreads and I mean, I've had several sequences of 10 or 12 credit spreads in a row where nothing is anything but 100% profitable. And then sometimes you break some rules, you do something, you didn't execute trades right, you misplaced a stop, something, and you'll lose a lot more than you ever expected to lose. The reality is you're going to lose money. Just get prepared. At one point, you're going to lose money. I've never taken the time to go back and see what my overall win-loss ratio over 100 trades would be. Most people would say that 70% is outrageous. And if you just come down to pure systems, 70%, there's never been a system developed, as far as I know, where 70% can get you there. My personal experience says that systems alone can get you in the 55 to 60% range, and human interaction, when executed properly, can get you into the 70, 75% range. The problem that most people find is somewhere in there, their personal side starts to break down. And so you'll have several trades where you really win a lot, and then you'll start to do some stuff that really screws it up. And that's why it's really important that you manage your risk per trade. And then another technique I'm going to teach in a second that I refer to as capital extraction. It's very important to take your profit once you get it. All right. So let's keep moving forward here. That's risk reward. Now, what's the risk per trade? Risk reward and risk per trade are 2 different things. All right. Risk per trade. Everybody agrees. You do not risk everything on one trade. This is trading suicide. You will go the way of Jesse Livermore unless you have better self-discipline. All right? The less you risk, the longer you can play. So it's important that you keep a balance, not just of your risk reward per trade, but you keep a risk reward per trade on your overall account. So how much? Well, here are some percentages. 5% of your account per trade. This is on the high end. I used to do this all the time, and I found that over time I was profitable, but sometimes I really took a lot bigger risks. I have started to really limit that, and my personal experience has been my Forex, foreign currency trading, has forced me to use better risk management, and I've really learned to appreciate a lot of these rules a lot more, because with stock trading, you don't have as much leverage. With option trading, 5% can work. I can even technically go up to 10%, although I really don't like that. It really can burn you. But if you're a good trader, you could probably get away with 10%. I just don't think you should gamble with it. 5%, I'm okay with that with options. You get into futures trading, you get into foreign currency, nah, it's not going to work. 5% is going to blow you out. You need to be limiting your risks per trade to 1 to 2% of your account. That's going to let you play a lot longer. And if you're really uncertain, a lot of people would suggest that you limit yourself to 0.5%. Now, if you only have $1,000 account, this is going to really, really limit you. Like, your commission could be 1% of your trade. So, you're going to have to fudge it just a little bit. And, the only way I can really say this is if you have a really tiny account, you're going to have to fudge it, and you're probably going to have to gamble a little bit just to get some winning trades and get some money built up. If you've got a $100,000 account, you're a fool, an absolute fool, not to follow strict money management techniques. Very, very important. Okay. And so, again, I'm giving you some principles. You have to decide how it works for you. That's I guess that's all I can really say. The more that I trade, the more money I have available to trade, the more I find money management very, very important. And so you guys can, again, you can apply that to your own personal. Let me just kind of look at a couple of risk per trade formulas here. Let me show you a couple of ideas, and you can see what I'm talking about. Okay. Let's say you have a $10,000 account. If you risk 5%, you're risking $500 per trade. Now, think about this, okay? Let's say that you buy 100 shares of a $100 stock. That stock then falls to $95 per share. You just lost $500. So, if your risk reward is set up, you're shooting for $120, that's your target, okay? Your entry's 100, and your stop is at 90.